The broadcast is now starting. All attendees are in listen-only mode.
Welcome everyone to Nova 401k Associates webinar, Cash Balance Plans for Advisors with Phil Allen. Before we get started, I would like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions. This is where you will enter in any questions that you may have for Phil, and he will be answering questions throughout the session. Please be sure to make sure your questions are as descriptive as possible. If time runs out and you still have questions, please send them to our email address, webinars@nova401k.com. Right below questions, you will see the handouts drop down. Here you will be able to download today's material. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out the survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who meet the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce to you Nova's Defined Benefit Assistant Team Leader for the Defined Benefit Administration, Phil Allen.
Thank you. And thanks everyone for joining us today. Good morning, good afternoon, depending on where you are. As Yvette mentioned, I am Phil Allen. I am one of 5 actuaries here at Nova. For those of you who don't know what an actuary is, basically it's a CPA who didn't have the personality to be a CPA, so we became actuaries. So I'm going to be talking about cash balance plans and give you a little introduction. We're going to start, I got to start with a disclaimer very quickly. I'm not an attorney. As I mentioned, I'm also not a CPA. So if you need legal advice or you need tax advice, don't call me. Call your ERISA attorney or your CPA. This presentation is intended for financial advisors and CPAs, also, small business owners who may be interested in getting bigger deductions for their retirement programs. We don't have a whole lot of prerequisites. The assumption is that everybody listening into this call is somewhat familiar with 401k plans, profit sharing plans. In general, you either have one or you've sold some or you advise clients on them. So we will be going, I will be covering a little bit of what should be stuff you already know on retirement plans and the various plan types. Then we'll dive deeper into cash balance plans, what those are, what the advantages are, why we're doing a presentation today on those, and why those of you on this call might be interested. As Yvette mentioned, please fire off questions throughout. I'm more than happy to pause and answer them, or if I can't answer them on this call, I can respond after. So let's dive in. So qualified retirement plans have always been good tax shelter, tax deduction vehicles. And for numerous reasons. Not only are they tax deductible for the employer, you defer the income tax on the investment, and when distributions are taken, they are taxed at ordinary income tax rates, but they can also be rolled over to another qualified plan or an IRA to defer those even longer. And this is one of the few places that companies can shelter some money and protect it from creditors coming after them in bankruptcy or other situations. So what do we look at when we're designing a retirement program for a organization? And typically we are trying to balance 4 main priorities, and oftentimes these priorities are competing with each other. We're looking for plans that or retirement programs that are understandable, affordable, sustainable, and administratively feasible. And we'll kind of walk through what that looks like and what, you know, maybe an optimal program will be, but just kind of keep those priorities sort of in the back of your mind as we're going through this presentation. But you can see how you know, the most understandable plan may not be the most affordable, or it may not be the most sustainable. An administratively feasible plan, it may not be the best, the easiest administrative plan may not be the best option for an organization, because it may not achieve the results that they want. So you can see how these priorities can compete, and this is why we like to partner with the advisors and the CPAs of organizations when designing retirement programs, because we want to make sure we're meeting as many of the goals of the organization as we can. And so if we're sitting in our little TPA silo at Nova and trying to design a plan, and we're not thinking about what deductions they're trying to get, or what the goals of the advisor are, that's not going to meet everybody's objectives and can end up frustrating clients. So as we move up the food chain, we tend to find more plans that offer more flexibility, but as you can probably guess, the complexity goes up a little bit. And so cash balance plans, they end up, and we'll see later on, they end up checking a lot of our boxes. The challenge with cash balance plans, at least previously, prior to PPA, the Pension Protection Act of 2006, they were, and there was a lot of administrative uncertainties and a lot of regulatory uncertainties around them. And PPA and subsequent guidance and regulations and that sort of stuff since then have cleared up a lot of that. So it makes cash balance plans much more appealing to certain organizations. Typically, or at least in the past, the early adopters of cash balance plans were bigger plans. They didn't really make their way into the small plan world until after PPA cleared up some of these uncertainties. And this is just kind of a follow-up to that. The IRS has issued some regulations that has given us even more clarity on it. There's been some court cases that eliminated some of the discrimination issues. When they first came out, there was a lot of noise around these plans, around cash balance plans being age discriminatory, and that's why a lot of small companies were staying away from them, because they didn't want to deal with that. And I don't blame them, but like I said, that a lot of that has been cleared up in these regulations and court cases. And as mentioned, the small plan world is all in on cash balance plans. We are seeing, if I had to guess, Nova, if we put in a DB plan, which cash balance plan is a type of defined benefit plan, if we put in a defined benefit plan, 99% of them that we're putting in right now are cash balance plans. And we'll see why. It's just a lot cleaner, a lot easier than a traditional what is thought of as a traditional DB plan. There's no reason to expect this trend to die down. There's a lot of appeal in these plans, and now that the regulatory uncertainty has been cleared up, we can see this trend continuing. So unless there's another major shift in the law, these are still going to be the dominant plans that are put in for certain organizations. I'll pause right there. I'm guessing there's probably not any questions, but if there are, let me know.
We are good. There's no questions at the moment.
Okay, perfect. So let's talk about the different retirement plan types. This is kind of a laundry list of the plans that are out there. The ones that I've bolded here on this slide are ones that we're going to at least touch on throughout this presentation. So I'm not going to get into things like SEPs and simples and ESOPs, but we will talk about profit sharing plans, 401k plans. Hopefully, most of this list is names and plan types that you have seen. You may or may not know the differences, and hopefully we'll touch on what the differences are. But this is the list that we use when we're designing a retirement program. We kind of pull from this list and figure out what is the best plan or plans. Oftentimes it'll be multiple. That is, what are the best options for a program for an organization, and which of these do we want to pull from to put into their program to meet the goals, whether those goals are deductions or those goals are socking away as much money for the owners or giving the best benefit, best bang for the buck for the staff. This is the list that we look at. Now, when we're dealing with retirement plans, qualified retirement plans, to be a qualified retirement plan, you can't discriminate in favor of highly compensated employees. And so there's a bunch of, I'll call it a bunch, there's a few, I guess, non-discrimination tests that we have to run to make sure that these plans do not discriminate in favor of highly compensated employees. And there's some guidelines around that. It's not, you'll see when we get, especially when we get to the cash balance, on the surface, they look like they favor the highly compensated employees because we're giving them a much bigger benefit compared to the others. But there's various tricks and tools of these tests that you can run to comply with the non-discrimination rules. We're going to touch on some of the tests, not all of them, but you'll probably hear or you'll see me mention ADP test, top heavy test, 401A4, things like that. You might be familiar with ADP and ACP tests because those are applicable to 401k plans. You've probably heard of those tests and maybe even a top heavy test. But 401A4 could be new to you, so we will talk about that. As mentioned, one of the trade-offs for allowing owners to put money away and it to be a qualified plan, we can't just set up a plan for the owner and say, okay, you're going to get all the benefit and you don't have to give your staff anything. That wouldn't be a qualified plan, and that would clearly discriminate in favor of the highly compensated employees. So one of the things that we typically have to do is give some sort of minimum benefit to the employees, and we'll see this a little bit more in some of the examples that I have, but a kind of a sort of a guideline for a safe harbor 401k plan, typically the minimum is 3 or 4%. So if you give everybody 3%, safe harbor non-elective contribution, then clearly that's not discriminatory because everybody's getting 3% of pay, even though the highly compensated make more money. So their 3% of their higher pay is more of a contribution on a dollar basis. Percentage-wise, it's the same. For profit sharing contributions, typically you have to give 5%, sometimes a little bit less, to satisfy these, and we'll see that when we talk about new comparability plans. And then if you throw in a cash balance plan, it typically ends up being about at least the most common plans we design at Nova, and you can design it multiple ways, but we typically give staff about $1,000 in the cash balance plan, and then it often works out where you have to give 7.5% of pay in a profit sharing plan to meet these requirements, which sounds high, right? I mean, we're jumping from a 5% to a 7.5%, but hopefully you'll see in a little bit that it's probably worth it for a lot of clients, because the bang for your buck on that 2.5% and that additional $1,000 is significant when you pull in a cash balance plan into the equation. So let's talk a little bit about profit sharing plans. As I mentioned, hopefully a lot of this is review for you, or something you've seen before. But this is where we start when we're designing a program. It's obviously the easiest plan to understand. Employees and employers understand it. They can see, they know if I put $1,000 in my 401k plan and that earns 5%, that all that money's mine. I'm getting that money. I could take that money if I, for whatever reason, if I quit or whatever, I can roll that money into an IRA. If I'm older than 59 and a half, I can take that money and do what I want with it. And it's always clear exactly how much money is in there, and it's individual accounts. And as I mentioned, there are some non-discrimination tests involved in this. Again, the government does not want you to set up a profit sharing plan where you give 50% of pay, if you could, if you're under the limits. Give 50% of pay to the owner and only give 1% of pay to the staff. Clearly, that wouldn't be acceptable. So just a quick little example of what you can do in a profit sharing plan, and this is a safe harbor non-elective that I mentioned before. Everybody gets 3%. So yes, the owner is getting a much larger benefit because the owner makes $205,000. It makes 4 times the average staff. So he's going to get 4 times the benefit. So it's not an awful design for the owner. It's costing him 3%. He's getting 3%. So the company as a whole is going to put in $91.50, and he's going to get $61.50 of that. So decent. He's getting 67% of the company's contribution. So now let's take it one step further. We're moving up that food chain, the complexity food chain. So we have a new comparability plan, which is slightly more complex than the safe harbor, and really the only additional complexity is we're now grouping people. We are putting people in various groups, and you can group them any way you want. You can group them by job title, you can group them by classes, typically the way we write our plans for new comparability is we put every participant in their own group. And that gives the plan sponsor the most flexibility. So you can, if you have 10 people, you have 10 different groups, and you can give every group a different allocation, a different profit sharing. Now, remember that we still have to pass the discrimination testing. And so we have to do additional testing here in order to make sure that we're not discriminating in favor of the highly compensated employees. And then there's also a minimum gateway that in order to do these plans, you have a minimum gateway that you have to contribute. And oftentimes that's up as high as 5%. One of the limitations of these plans, of any 401k plan, is there's a contribution limitation. So DC stands for defined contribution. So we're defining the contribution in the plan. Every year, how much you contribute per person is defined. DB plan is a defined benefit plan, and we'll talk about in a little bit why that's different and how that's different than a defined contribution plan. But because it's a DC plan, there is a limit, an annual limit on the contributions that can be put in. So for 2022, that limit is $61,000. So that's all in. That's deferrals. If I defer some money and you match that money and you give me a profit sharing, all of that has to be $61,000 or less. If I'm over 50, I can put in a $6,500 catch up as well. So we're limited on the dollar amount in these plans, which we'll see that changes when we introduce a defined benefit plan. So expanding on our kind of simple example, the previous version was just a safe harbor, non-elective for everybody, so everybody got 3%. Here we've tweaked that. The safe harbor is we're only giving that to the NHCEs, the non-highly compensated employees, and then the owner so each of these are in their own profit sharing group, even though we're given the same percentage to the NHCEs. They're in their own profit sharing group. So employee one, employee two are both getting $1,000 in profit sharing plus $1,500 in safe harbor. So that's that 5% minimum gateway there. And then the owner, we're able to max him out at the since he's 60, he gets his catch up. He's maxed out his deferrals, and so we top him off up to that 61,000 plus the catch up. We top him off in the profit sharing plan with $40,000. So a big bump now in both the amount of money that he's getting, but also in the percentage. The company contribution, the company's putting in $45,050 between the safe harbor and the profit sharing, and he's getting $40,500 of that. So we've bumped up from the 67 or so % that we had in the safe harbor profit sharing plan to, by switching to new comparability, we've bumped the owner up to 89%. So again, we're moving up that food chain. You can see the numbers are getting better, more appealing for the owner. Complexity, it's slightly more complex, right? We now have an additional piece of a profit sharing and not just a safe harbor for everybody, but still not that complicated. These employees will clearly understand what's going on, that the company is giving them $2,500 in a between safe harbor and profit sharing, and it's in their account, and hopefully everybody's happy in this situation. 5% a 5% contribution in a 401k plan is not a bad deal for for rank and file employees, especially these days. So we typically will use a safe harbor design paired with a new comparability. The primary purpose of that is it does eliminate the ADP and ACP testing, and then you can vary the profit sharing piece, and the only thing you have to satisfy, which is definitely a little complicated, but you have to satisfy the 401A4 non-discrimination testing. So you don't have to worry about the other two tests, the ADP and the ACP. So typically we would design a new comparability plan with a safe harbor 401k plan. And the safe harbor, the other kind of added bonus is typically these plans will end up being top heavy, which means that the majority of the, or over a certain percentage of the assets in the plan are for key employees. And so if designed right, that's typically how they'll end up being, is they'll end up being top heavy. And there's a top heavy minimum requirement, which is 3%, and that gets satisfied through the safe harbor. So, and then as I mentioned, there's an additional gateway for the new comparability that you may or may not have to satisfy, and that could be up to 5%. And the safe harbor counts for a portion of that, and then the profit sharing, you add in the profit sharing, and that satisfies the gateway. And then the non-elective safe harbor contributions, they're considered, we do get to count them in the 401A4 testing, the non-discrimination testing. We don't get to count matching in that testing. So our most common plan design for new comparability plans, and subsequently when we get into combo plans, is going to be a non-elective safe harbor, just because we get the extra bang for our buck of using those contributions in the 401A4 testing, whereas, as I mentioned, matching does not. So we get that question of a lot of if a 401k plan is already established and they have a match in place, when we run an illustration, we will typically recommend that they switch from a match to a non-elective safe harbor, and we get the question of why. That this is why, that there's advantages to having it as a non-elective safe harbor versus having it as a match. And we'll see a little bit later on that the other common thing we do is we exclude the HCEs from the safe harbor non-elective. And you saw that on my example too. We excluded the owner from the safe harbor. You can always make that up in the profit sharing, because again, the owner's in their own group, and so you can make up that what looks like a 3% loss, but it's not. But you can make that up in the profit sharing, and by excluding those people, then it allows for a little more flexibility in later plan designs. So that's kind of a somewhat brief overview of DC plans, 401k plans. I'm going to shift to DB plans, but I'll pause right here for if there's any questions.
No questions coming in yet.
Okay. So let's dive into DB plans. Why are we talking about DB plans? And the short answer is because cash balance plans are a type of DB plan. And so a defined benefit plan is, now this is where we make the biggest leap in complexity. A DC plan is, as I mentioned, very, very easy to understand. A DB plan, and especially a traditional DB plan, and I'll explain what that is in a second, they're much harder to explain, and harder for rank and file employees to understand. Oftentimes, owners can understand them, but rank and file is a little more difficult. The defined benefit, as the name says, the benefit is defined. So a defined contribution, we say we're going to put in 3% a year as your contribution. A defined benefit, a traditional one, might say your benefit is going to be defined at retirement, and it's going to be defined as an annuity at retirement. And so it may be something like you're going to get $50 per month times your years of service starting at age 65, and you'll get that for the rest of your life. So if you have 10 years of service, you get $500 a month for the rest of your life. So you can see how if you're a 40-year-old and somebody's telling you about a benefit that you're going to get in 25 years, it gets much more complicated, much more confusing about how to wrap your head around that. What does that really mean? Versus if you're going to give me $1,000 a year in a DC plan, that's much easier for me to understand. And then there are some there's some mandatory annual employer contributions. So these aren't discretionary. You're required to put in contributions if you have a DB plan. And we'll see that, and we'll talk a little bit more about that. Now, why would anybody do these? Well, the primary reason, especially for smaller companies, is you get much higher deduction than you can get in a new comparability plan. So here's an example of a traditional DB plan, defined as 10% of final average pay, 3-year final average pay, times years of service with a 10-year cap. So basically, if you have 10 years of service and you take the average of your last 3 years of pay, and you're going to get 100% of that as an annuity for the rest of your life. And it may be, and then you have options that you can take that on. You can take that as a joint survivor. So it would be paid on your life, and then if you die, your spouse gets either 100% of that or 50% of that, or something like that. And the benefit prior to retirement is it's based on age and service as of that date. So if that 40-year-old quits, then their age 65 benefit is based on pay and service through the date that they quit. Now, as we saw on the DC side, there's an annual maximum contribution. Well, since this is a defined benefit, the maximum switches to being a maximum benefit upon retirement. And so the maximum annuity that somebody can get for 2022 is $245,000 a year. And every year contributions are required, and because we're dealing with annuities, we have to look at life expectancy. We have to do various, I'll call it complicated calculations. And so an enrolled actuary has to certify the annual results. And so an enrolled actuary certifies the present value of the benefits and determines what the required contributions are. And so the administration of these plans, the administration cost does go up marginally over a DC plan, just because we do have to have an enrolled actuary involved in signing off on these things. And the benefits under the plan, they're an obligation of the employer, not of the participant themselves. So quick little fun fact here. Out of these 3 people, and I didn't set this up as a poll or anything, so you guys can just say it out loud to yourselves, but who do you think can get the largest DB benefit between Bezos, Tom Brady, and a small business owner? Surprise, they all can get the same. As I mentioned, the benefit, the maximum benefit is an annual maximum benefit for everybody, regardless of what your pay is, regardless of who you are. The maximum benefit annual annuity you can get under a DB plan is $245,000 at age 62. That gets actuarially reduced if you're younger than 62, gets increased if you're older than 65. So Tom Brady, I think he's around 45 right now. So if he quit today, which he'll probably play for another 10 years knowing him, he could get, in a qualified defined benefit plan, he could get approximately $7,000 a month. And that's the maximum annuity that he can get. I hope he can live on that. So now let's shift to cash balance plan. That was sort of laying the groundwork for DB plans. And as I mentioned, cash balance plan is a type of DB plan, but it's simpler to understand than a traditional DB plan. So let's talk a little bit about numbers and why you would consider a cash balance plan. So as mentioned before, there's limits on DC plans on what you could put in. There's limits on DB plans on maximum benefits. Well, we can take those maximum benefits and we can convert those to lump sums. And so the approximate maximum lump sum that you can get in a DB plan, subsequently a cash balance plan, is after 10 years of service. It varies by age, but at 62, you can get approximately $3.1 million. So if you think about it, if you're trying to build an account to get to $3.1 million over 10 years, you're not going to get there by putting $61,000 away in a year in a DC plan. So you can see how your deductions can start to escalate pretty rapidly when we introduce a cash balance plan. And here's just kind of back of the envelope numbers as far as the deductions that you can get in a cash balance plan and what salary you need, because the other thing that can bring that maximum benefit down is the salary. So that $245,000 is a maximum benefit, but it can't be more than 100% of pay. So if your pay is only $50,000, then your maximum annuity is at 62 is going to be $50,000. So the pay that's required to get these maximum deductions is on the far right-hand column. The estimated max deduction, say for a 60-year-old each year in a cash balance plan, is about $308,000 if you're making $305,000. $305,000 is the maximum pay that we can use in a qualified plan, whether it's a DC plan or a DB plan. So if somebody makes $500,000, we're going to limit that pay to $305,000. Any questions at this point?
No questions, Phil.
Okay. So I've kind of hinted at this, like what is really a cash balance plan? And it is a DB plan, as I mentioned, but it's what we call a hybrid plan. It's a DB plan that looks and acts a little bit like a DC plan. So it's much easier for plan participants, business owners, advisors, CPAs. It's much easier for all of us to understand. And because it looks like a profit sharing plan. And one way that we kind of encourage people to think about it is think about it as a guaranteed profit sharing plan. It's a guaranteed benefit that you will get at some time in the future. And that future can be when you quit employment. So you can take your payout as a lump sum when you leave the company, and you can take that and you can roll it into an IRA. So while you're earning the benefits in the plan, they're all a hypothetical account balance. You can turn that hypothetical into a real account balance when you leave, or when you terminate the plan, and you can roll that into your qualified DC plan, or you can roll it into your IRA. As I mentioned, because it's a DB plan, you have to have an enrolled actuary to determine the funding levels, the required minimum levels. There's also a maximum deductible that you can do each year, and the actuary will calculate those numbers for you each year. Actuary will also run the discrimination testing for you as necessary. So the mechanics of a cash balance plan. As I mentioned, it's a hypothetical account balance or a notional account balance established for each participant, and each year they get a contribution. We'll call it a contribution. We also call it a pay credit, but they get a credit credited to their hypothetical account balance, and then each year that account balance earns interest. And we don't, because it's a DB plan, we don't have the contribution limit each year for the individuals, and we'll see how that translates to real dollars in a sample coming up. The interest credit is a plan provision, so it's in the plan document, and it's typically not the actual return earned. The assets are pooled there, and so there's one trust account for these, while there's a bunch of hypothetical accounts for the individuals. There's one trust account for the benefit of all the participants in the plan. So this would be an example benefit statement. We send out annual participant statements every year on these plans, and this is kind of a simplified version of what it would look like. This plan, as you can see, that the contribution's $1,000 a year, and the interest credit's 5%. So at the beginning of the year, their hypothetical balance is $20.50. Their interest is $103. They get $1,000 for being there in 2022, and then by the end of the year, their hypothetical is $31.53. If they're vested in this, which this participant likely would be, if they're vested in this, they could leave on 12/31/2022, and they could roll over $31.53 into an IRA or something like that. So again, it looks like a DC plan, right? It looks like a DC plan that's giving me a guaranteed rate of return of 5%. So not a bad deal for even for rank and file participants. So let's add in some more people to this example, and look at some possible formulas. Pretty much anything under the sun is available, but we tend to stick to either some sort of percent of pay formula for a cash balance plan, or a flat dollar amount. And this is what we call the pay credit or the contribution. The interest credit is typically going to be some sort of fixed rate, which we'll touch on in a sec. So one example would be you give the owner 75% of pay, all the other HCEs 20% of pay, and then everybody else, so the non-highlies, you give them 15% of pay. So you can have classes like you do in new comparability plan, but you can see it's much higher limits. You couldn't give in our previous example of the new comparability, where I think in that example we had the owner making $205,000. Even at $205,000, he couldn't get 75% of pay in a DC plan because he'd blow through that $61,000 maximum contribution, annual contribution. So another alternative, as I mentioned, we also do kind of flat dollars, would be $150,000 a year to the owners and $1,000 to the NACs, and nothing to the other HCEs. The benefit there of excluding the other HCEs is you have the flexibility to give them additional profit sharing if you wanted to. So let's play this out to a slightly bigger group than our previous one. So we have 2 owners making the max, at least the max comp, and then we have 9 staff members. And this is a standalone cash balance plan. So we're assuming there's no partnering DC plan here. And so we do have to pass, this has to pass non-discrimination on its own without the aid of an additional plan. So we are given 15% to the staff. We're given 75% to the owners. So again, you can see the dollars have significantly increased for the owners. The staff is getting more because they're getting 15% of pay, whereas in the new comp plan, they were getting 5% of pay. So that's the staff cost does go up, but again, we're not limited to the $61,000 for the owner. So we've, out of the $487,000 contribution, 94% of that is going to our 2 owners. So again, another big jump. I mean, we thought 80 something, I think it was 87% for the new comp was good. This is even better at 94% plus much bigger numbers. So the deduction has gone up. The contributions for the owners have gone up significantly. So now I am going to do my best to be a telemarketer for you, or not a telemarketer. What are those called? The TV sales guy. I'm gonna sell you my Flex Seal right now. That this gets even better, if you can imagine that. We can get that 94% even higher if we partner this cash balance plan with a DC plan, with a new comparability plan. Now, some of the things that happens when you do partner, there are some additional requirements because again, we can't discriminate in favor of the HCEs. And so there's some additional minimums. The gateway now changes from a what would typically be a 5%. It goes up to potentially 7.5%. But we do get to cross test these plans, and so we test these on a benefits basis, and that's why we can typically get away with this. And I'll talk a little bit about that when we look at the example on the next page. And then, as I mentioned, we'll typically put in a safe harbor 401k, the safe harbor non-elective to the NHCEs. That allows us to, that helps with the gateway, and it also helps with the non-discrimination testing. By excluding the HCEs, we have the ability to give them additional profit sharing if we want to, and we don't. If we included them in the safe harbor or non-elective, then that could potentially that could potentially mess up our testing. So we exclude them to give us the flexibility or to give us the most favorable results in our testing. And what basically what I briefly mentioned cross testing, what that means is we can test these on a benefits basis. So we can test in our example here, we have a bunch of staff who are in their 20s, and we have owners who are in their 60s. Now, did we cherry pick the best possible group for this sample? Maybe. I mean, this is definitely, if you have a client out there that has a company that has demographics that look like this, then they are absolutely going to be a great candidate for a cash balance plan. You have owners who are closer to retirement, and you have younger people who are the NHCEs. And the reason that this setup is so advantageous is because we basically project everything to retirement on a benefits basis, and we test it there. So if you think about it, if I give you $1,000 and you're 21 years old, then that $1,000 gets to grow until 65 with some sort of interest. So it's going to grow for 44 years. Whereas the owner, if I give him something, and let's just say I give them $1,000 at 60, that's only going to grow for 5 years. So the $1,000 I gave the 21-year-old is much more valuable today than giving a 60-year-old $1,000 because of the testing it on a benefits basis. And so that's why we can get some of these big discrepancies and be able to put away, you know, in this example, $228,000 in cash balance to the owners, and not as much to the staff. So what we've done here is we've partnered the cash balance plan with a DC plan. So we were able to reduce the amount, because we don't have to pass the testing, the cash balance plan on its own. We can reduce the amount that we have to give to staff in the cash balance plan. And then subsequently, we give them 7.5% in the DC plan between the profit sharing and the safe harbor. I've combined them here, but we give them 7.5% to basically pass the gateway, but it also passes the non-discrimination testing. So we gave them 2% in cash balance plan and 7.5% in profit sharing. If you remember, on the cash balance alone plan, we gave them 15% in the cash balance plan. So now we've reduced that number from 15% down to 7.5 plus 2, so 9.5%. So we've saved $14,000 in staff costs, but we also were able to get an additional $135,000 to the owners between a deferral and a profit sharing that they were able to put into the DC plan. So our 94% has now gone up to 96%, and the dollars have gone up. The dollars to the owners have gone up. The dollars to the cost, the staff cost, has actually gone down. So you can see why that's pretty advantageous. I'm going to kind of speed through because I know we're getting a little tight on time here. But I think I've mentioned most of these advantages. These plans are easier to understand. The asset allocation is typically correlated. It's pretty correlated to the interest crediting rate, or if it is, I should say. Then the assets and the liability in the plan will be pretty well connected. So while there's a required minimum contribution and a maximum deductible contribution, typically the annual contribution or hypothetical contribution will fall between those. So typically these plans can contribute the hypothetical contribution and satisfy all those required contribution numbers. There is an additional, I'm not going to go into a ton of detail on this, but in the Tax Cuts and Job Act that was passed a couple years ago, there's an additional deduction that is available for certain entities, for certain pass-through entities. So our recommendation is talk to your CPA about that if you might qualify for that. So you might be able to get an additional deduction for a cash balance plan, so you get even bigger bang for your buck by putting in these plans. There are, because it's a DB plan, there are additional requirements, and I think I've mentioned most of these. You typically don't have in-service distributions in these plans, but you can write it into your plan. You can write it in as early as 59 and a half, but most often plans don't do that. You keep that in the 401k plan. Vesting, you cannot use a 6-year graded vesting schedule like you can on a DC plan. You have to use a 3-year cliff vesting or something better than that. So you can do a 2-year cliff, you can do immediate vesting, but it needs to be a 3-year 100% vesting cliff or better. A couple additional requirements. Because it's a defined benefit plan, to take your benefit in a form that is not a joint life annuity, then you must get spousal consent to take it. So as I mentioned, you could take your account balance as a lump sum, but you have to get a spousal waiver. Your spouse has to waive their right to a joint annuity. It's the assets are not participant directed. It's a trustee directed account. Some plans, if you're not a small professional firm like a doctor's office or a law firm, or an owner only, so if it's just an owner or owner and spouse, if you're not one of those organizations, then you will be covered by the PBGC, which is a government insurance agency that insures defined benefit plans. And so because it's an insurance, there's a premium, and it's basically, you can expect about $90 a participant. For 2022, the flat premium is $88. And then for underfunded plans, there's additional premiums on top of that. Underfunded meaning that your liabilities in your plan are greater than your assets in your plan. So who should think about a cash balance plan? I think I've mentioned a few of these, but professional firms for sure, owner onlys, especially if the owner is over 50. If you remember that previous slide of the deductions, that the older you are, the higher the deduction you can get. Larger companies that are looking for a DB plan that their employees can understand. If you have, and then this you kind of saw in my example, if you have a staff that is 10 or more years younger than the owner, you're going to get the best bang for your buck. But that doesn't mean if you have if everybody's similar in age, that doesn't mean this isn't that this won't be appealing for those companies either. It's just you get a little more leverage when you have a younger staff. If you're already taking advantage of a new comparability plan, then it probably doesn't hurt to look at a cash balance plan and just see if you can get a little, if you can squeeze a little more out of the lemon here. And then organizations with an existing DB plan who may want to switch to a cash balance plan. Now, why would a company, sorry about that. Why would you want to switch to or add a cash balance plan if you're on a new comparability plan? And basically, if you're already budgeting 5%, then you can, for very little additional cost, you can add in a cash balance plan. So if you have somebody in this situation, feel free to reach out to us, reach out to your Nova retirement consultant. And if you give us last year's allocation report, we can run a cash balance illustration for you. I already talked mainly about this. You know, why haven't you heard of a cash balance plan before? Because of the legal uncertainty that has mostly been cleared up. There's also a 25%, there was a 25% pay deduction limit when you have both a DC and a DB plan. That's kind of gone away for the most part. And so you can deduct more than 25% of pay as long as the DC contributions are less than 6% of pay. That's if it's not PBGC covered. That doesn't come into play if your plan is PBGC covered. And then the interest crediting rate, the question we get most often is, can I use the actual return on assets as my interest crediting rate? And the short answer is yes, but we don't encourage it. And the reason being is because it adds some major headaches. A couple being that the non-discrimination testing, how you do it and how you pass it in that situation is unclear at best. Also, there's a rule in the cash balance regulations that you have to preserve capital. So, for example, if your hypothetical allocation is $1,000 a year, and you can't ever drop below the sum of those contributions. So let's say after 5 years, that's $5,000. If you have a market rate, or if you have a actual rate of return, then and that's negative, you still have to have a $5,000 minimum for that person. So if the assets drop in half, you can't say that their hypothetical account balance is now $2,500. It has to be $5,000. And then we do have to have real pay for these plans. So what does that mean? It needs to be either, depending on your organization, it needs to be either W-2 pay or Schedule C, line 31, and that needs to be a positive number. K1, line 14, same thing as well. So basically, if you pay self-employment taxes on it, then it's pay that we can use. If you don't have pay, you can't get a benefit in this plan. If you remember, the maximum benefit is limited by 100% of pay, and I think we can all do that math. 100% of zero is zero, so you can't get a benefit in a plan with no pay. Does the investment allocation need to match the interest crediting rate? No, but word of caution, you want to be careful of having a severely underfunded or even a severely overfunded plan, because those maximums that I showed, those are the maximums that you can take out of the plan. And if you blow past those, there will be excise taxes that you pay on those. And then underfunding, if the plan is severely underfunding, the minimum required contribution each year is going to go up, because you're required to fund that over a period. The underfunding, you have to fund that underfunding over a period. And then I won't get into the converting, but you can convert a traditional plan. One additional requirement is there is a minimum coverage that you have to cover a certain number of people, and it's basically 40%. So if you have 2 people, you have to cover 2. If you have 10 people in your company, you have to cover 4 people in a DB plan or cash balance plan. And then the gateway, I mentioned the gateway is a little bit different than a new comparability, and it's basically a third of the highest HCE rate, or if that's over 15%, then it's either 5, 6, 7, or 7.5%. So this is where I mentioned the 7.5% if you're going to, if the HCE is, if their rate is 35% or higher, then you need to give everybody a minimum of 7.5%. But that can be in the profit sharing plan. That does not need to be in the cash balance plan itself. And because this is a retirement plan, the IRS expects it to be permanent. What does that mean? We don't really know, but informal guidance has suggested that 5 years is a reasonable minimum. What they don't want to see is these companies setting up these plans for a year, throwing a bunch of money in there and then shutting them down without some sort of valid business reason. Clearly, if you sell your company, that's a valid business reason to shut down a plan. So just keep that in mind too. The expectation is if you open this plan, you're going to keep it open for a little while. When can I adopt a plan? After the Secure Act, you can actually adopt after the plan year end, the first plan year end, up until your tax return deadline. NOVA typically recommends that you adopt it by the end of January for calendar year plans. If you want to put one in, say for 2022, and you want it in by the end of the year, which isn't required, but if you want to put it in by the end of the year, then at least NOVA's deadlines are early December, so we can get it drafted and adopted. And if you're considering this, especially for 2022, we would encourage you to have your CPA prepare a preliminary tax return so you can kind of gauge what sort of deduction you'd like to get as part of this. And then funding your new cash balance plan, we encourage you to wait till your plan document is signed and dated to fund. That's also when the trust gets established, is part of the plan document. We encourage quarterly funding, but we understand that every business is different and has different cash flows. And with that, I think that is all I have. Don't forget to get your CPA credit. If you have additional questions, or Yvette, if there's any questions now, I can possibly answer them, but if not, I can respond.
Yep, we have a couple that came in. The first one is, why do you have to limit the pay? Is this a regulation?
Yes, so, and that's for all qualified retirement plans, even defined contribution plans. If your plan, for example, if you have a safe harbor non-elective in your plan, that 3% of pay, that pay that you can use for that 3%, that's limited. And same with a defined benefit plan. If you're defining, let's say, a cash balance plan where you're going to give 75% of pay, then there's a limit on the pay, and it's IRS limits that change every year. They go up with cost of living, but every year there's a compensation limit for qualified retirement plans. That's in. And the reason being is when you have the owner making $2 million, if you have a 3% safe harbor non-elective, they don't want you to put in 3% on $2 million and you still say, oh, I don't have to do ADP or ACP testing, but I can max out my DC contribution because my pay is so high. And same with a defined benefit plan too. It's an IRS maximum compensation limit for a qualified retirement plan.
Okay, next one is, it says, my client HCE is only 50 and his paralegal is 65. So I was told a cash balance plan won't work for him. He has a safe harbor 401k plan. If his paralegal is going to retire, can our firm run projections for him for a potential new hire? The estimated contributions to the cash balance plan would be part of the compensation package.
Yeah, I think I followed all of that. It sounds like there's a lot going on there. I would actually recommend that if whoever asked that question, if you have a relationship with one of our Nova sales reps, reach out to them. If not, email that exact question to this proposals at Nova 401k. We can for sure run an illustration on whatever situation you're talking about. If it's the paralegal's going to retire and you want to see what a plan would look like after that happens, or if you want to see what a plan would look like prior to that happening, we can look at all of that and show you what their options are. That just in general, that question's a very good question, because we do get that a lot. That typically doesn't sound like the best demographics, but that doesn't mean this type of arrangement won't be appealing, because maybe in that situation you're okay giving paralegal a pretty significant retirement benefit, and the owner's still going to get a large deduction and contribution to their plan. It's just going to cost a little more, but remember, that's money that's money that's going to your employee, not to the IRS. So while you're getting the tax deduction, so you don't have to pay the IRS, it's going to cost you something, but that money is going directly to your staff, and not to the government. So it could be appealing to that client.
Okay, our next one says, do you expect growth in the number of cash balance plans for employers with 100 to 1,000 employees?
Yes, I mean, because that question was general enough. Do I expect growth? Yeah, only because there's not a ton in that space, and so even adding a few would be growth. Significant growth, maybe not, but I do expect it to be. I mean, we're seeing more and more proposals coming in that kind of range of what we would call mid-size companies. It just depends on what the owner's appetite is for paying for these types of plans, because the rule of thumb is kind of that slide that I showed before. You probably need to give $1,000, maybe a little less, but you could budget $1,000 cash balance contribution and 7.5% profit sharing contribution. So if those numbers don't scare you as the owner of giving that to the staff, then this for sure would be appealing. And we are seeing more and more of companies of that size doing that. But the biggest growth is in the smaller companies, 10 employees and less. And then definitely in the owner-only space as well.
Okay, our next question is, what are cash balance plans typically invested in? How is the interest credited?
So the interest credit is a plan provision in the plan document. So the interest credit is on the hypothetical account balance. The investments can be invested in any reasonable investments. I mean, there's some rules around. If you get too exotic, then you would be required to get an audit on your plan. And so, but I would defer the rest of that question to your advisor, because the advisor is the one who's going to invest these. The caution that we would give is what I showed on a couple slides previous, is that you just want to be careful of either having an underfunded plan that you're going to be forced to fund up because there are required contributions, or a severely overfunded plan because the benefits, the maximums that you can take out of a plan are governmental maximums. And so while you could have really good asset returns, you may not be able to take all of that out of the plan without paying some sort of excise tax. And I think it's a 50% excise tax. So just to give you a quick, or give you some numbers, that I showed you that slide that said a 60-year-old can get 3.1 million as their maximum benefit. So let's say you have a plan that has a 60-year-old that's been around for 10 years. And the maximum benefit that if they terminated that plan right now that they could take out is 3.1 million. And let's say that you had really good asset returns and you ran that up to the account balance, or the trust account, so the actual assets in the plan, to 3.5 million. He can take out 3.1 and roll that over. The other 400,000 that is still in there, that gets reverted to the company and there's excise tax on it. So you'd pay 50% on that 400,000. Now, is that a big deal? That's up to you and your client. That's all earnings that you're paying a little additional tax on that you've already deferred, that you didn't pay taxes on earlier. So it's not like you're still getting 3.1 million that you can roll into an IRA and continue to defer the taxes on it, and you got all the deductions for those years. So it's not, it sounds bad because there's an excise tax and you got to pay it, but it's because you out earned what you expected. And when we build these plans to max out, we build them with, we set up the hypothetical account balance and the interest crediting rate to target that, for in that example, that 3.1 million at age 62 or at age 60. That's our sort of our bogey. So we would set up the allocation every year plus a fixed interest crediting rate to peg that 3.1 million after 10 years.
Okay, our next question. If a business owner is less than 10 years from retirement, is the cash balance plan suitable? Can you explain the 10-year requirement?
Yeah, for sure. The 10-year, the only thing with the 10-year is that that's maximum benefit. So let's call it the 3.1 million or the 245,000 annual annuity. That maximum benefit gets phased in over 10 years. So the only difference is if the simplest way to look at it is if they only have 5 years, then that maximum benefit's cut in half because it's you phase it in equally over 10 years. So no, it's not a big deal if the person is under 10 years from retirement. It's just that maximum benefit that they can pull out goes down. But like I mentioned, the way that we build these plans, it's going to be the same whether they stick around for 5 years or they stick around for 10 years. The allocation will build up to that 5-year point. It'll build up to that 10-year point. So we would, if after 5 years the max was 1.5 million, say, we would build towards that. And then subsequently, if they hang around for 10 years, they would get up to the 3 million or the 3.1 million.
All right, so and we'll do one more just because we're quite a bit over already.
Okay.
The last one we have is let me see right here. What happens with the plan at termination? Do you pay out employees at the contributions plus their growth rate? What happens when assets don't match liabilities? Do the owners get the excess if assets are more?
Yeah, so that that the answer can get complicated, but the simple way to look at it is because it's a defined benefit plan, the benefits are defined. You have to pay out the benefits under the plan to the staff. So that if you think about that participant statement that I showed you, that the participant had, I think, $3,100 or whatever in account balance. When you terminate the plan, or if that participant terminates the company, you have to give that participant $3,100. They're entitled to that. If the assets don't match all of the account balances, then the difference, if the assets are short, then a majority owner could waive their benefit down to the they can take a cut in their benefit, but only the owner can. You can't cut anybody else's benefit. So that $3,100 has to be paid to that staff. And then if you don't have enough assets to pay the owner's benefit, they can waive their benefit down. If you have excess assets, that gets spread amongst the everybody in the plan. But the you have to spread it in a non-discriminatory way, but it typically ends up being where the owner gets the significant amount of the excess. But the rank and file will get a little bit of the excess in that situation as well.
Alrighty, perfect. Well, we will go ahead and end it now. Just a reminder to fill out the survey at the end of this webinar so we can track who will be needing a certificate. If you have any questions, please be sure to email us at webinars@nova401k.com. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you, Phil, for your time today, and thanks again to everyone for joining. We hope you enjoy the rest of your day. Bye.
Thank you. Bye.